to welcome back to another episode of Modern Money with TJ and Mike. How are we doing today?
Doing well, TJ. Good to see you. How are you?
Doing well. Can't complain. It's almost Friday, so that's always a good thing.
Absolutely.
Let's get right into it today. So I know today we were going to focus on myths, popular kind of financial planning, investing, money myths that we hear from people a lot. So I just want to kind of start off and hear, what are your kind of top of mind myths that you come across a lot with clients or people in general?
Yeah, absolutely. No, there's certainly a list, right? And I know we have some good ones. So I guess one that I see somewhat often is related to Roth IRAs. They are retirement specific accounts, right? And there's a myth that they cannot be touched until retirement. And why there's there is some truth to that. That truth is more so focused on those pre-tax accounts, those IRAs, and the 401ks. Roth IRAs, if you're doing regular contributions, you're actually allowed to take those contributions out at any time. Like, for example, if someone's eligible and they put $1,000, if they're young and below the income threshold, they put $1,000 into their Roth IRA today, they're allowed to take that out tomorrow. That earnings piece is the part that is more, quote, untouchable, or you would, there are some ramifications if you did pull the earnings out before retirement. Again, so similar, if you're age 40, you've put in 100,000 total, it's now 200,000. You can take out half of it, no problem. So it is a retirement account, but it's not as untouchable as some people think. So how about yourself?
Exactly. I hear that a lot too. People in general are kind of a little hesitant to sometimes invest in retirement accounts in general, because they're like, oh, I can't touch this money until age 59 and a half. And what I would say is, like, just in general, right, we want to try to use up these tax deferred accounts because it makes our money go further. But obviously, if you do have short-term needs for your cash, then maybe it doesn't always make sense to max these accounts. But the Roth IRA is that great blend there, because like you said, you can always pull out the contributions penalty and tax free. So it kind of acts as that secondary cash reserve. So it's a super flexible account. And I agree, that's a great myth that people say is, I can't tap into my retirement accounts. So I would agree with that. The one that comes to mind for me first would be around taxes in getting married. So a lot of times people will think that getting married provides tax breaks or tax benefits, as far as like where the marginal brackets are. And while that can be true in some scenarios, it actually can negatively impact you in certain scenarios. And so where it benefits you is if one person is the primary earner. So this is probably where people are thinking of this benefit as if, one person earns the majority of the income in the household, instead of going from, now they're going from an individual bracket to a married filing jointly bracket where they're spread farther apart. So they're not hitting those same marginal brackets at certain income levels. But if two people are kind of the primary earners, and nowadays kind of in society where we're at, we have a lot of dual income households, it actually can negatively impact them if they're higher earners, because once you start to get into those higher brackets, you're not getting a kind of proportional increase in brackets. So you're hitting that higher bracket sooner than you would have as an individual, and therefore you end up paying more taxes. How do you feel about that?
Yep. No, absolutely. You're right about that. Sometimes that's referred to as the marriage penalty. Again, that's most of the time, right? Most of the time it does, there is a benefit, but you're right. If there are two earners, close to equal, they might not see that much of a benefit. But if there's two earners where they earn a lot, like you mentioned, the higher brackets, once you get into that 35, 37% bracket, which are the two highest, that's when you do start to see that marriage penalty. And I would say sometimes, even if folks are not subject to it tax wise, they might feel it, because not only does the tax code penalize that, the withholding forms with their employers are outdated as well. So two earners, maybe equal earners, they are getting withheld as single. They get married, they're excited, they update their withholding form W-4 at their new job and move from single to married. A lot of times that reduces your withholding, because again, traditionally, right, if there was one earner, you would have to pay less. So it reduces your withholding. And then come tax time, they owe a lot more. So yes, high earners are subject to the marriage penalty, and not that high earners sometimes feel like they are because of later withholding.
Gotcha. Yeah, no, that makes a ton of sense. And that's why it's so important that when you do get married, that you are thinking about your income as a joint entity and working together to kind of utilize all of your tax benefits, tax deferred retirement accounts, things like that. Because at the end of the day, you are a joint entity now. So you want to make the most of your income. What is next on your list for kind of those biggest myths that you come across?
Yeah, absolutely. I think a good hot topic, and maybe this would be good for us as well, is renting and buying real estate.
Mm,
It's commonly said, it's just a standard belief, right? Renting is throwing money away. Um, you know, we may have different feelings on that, or similar feelings, but even situationally, we're personally renting currently, and you're personally homeowner currently.
yep.
So, we've seen this one sort of, I don't know, debunked a lot, or discussed a lot. But essentially, it's not throwing money away. Right? You're
Yes.
For everything you're buying, every expense you're buying something, right? And
Correct.
when you're buying a home, you're buying certain things. And when you're renting, you're buying certain things, right? It's a direct transaction between you and maybe a landlord. You're getting the roof over your head. You're getting
Right.
the option. You're getting the optionality, not just with your life, and the ability to move easier. The optionality with your cash, right? And you might have the $50,000 to $250,000 for a down payment,
Yeah.
but maybe you're choosing to allocate that elsewhere, right? Maybe you want to have the plumber come and have the landlord take care of it, versus having to source it out yourself. So it's not, there's certainly, it's all a math problem, right? It's like you could run different scenarios with different uh, growth figures and whatnot, where renting could be more advantageous, right? Or buying could be more advantageous.
Right.
Um, so it's not that one is superior than the other, but I think it's villainized, if that's the right word.
For sure.
It's sometimes I find myself, I'm like almost like leading like a renter support group for some clients, where it's like, they might feel abused by society or articles or friends that they're renting, and it's I'm here to tell them, hey, it's okay. I'm supportive of buying, but
Yeah.
renting the renters get beat up a little bit.
Oh, for sure. There's, it's almost like a propaganda of like you have to own real estate to be successful. I think it's like an easy way for people to think like, sometimes people don't know how to store their wealth. They're not comfortable with investing. And so real estate is what they know. They've seen their parents do it. And so they're comfortable with it because they don't know the options out there as far as like investing in the stock market. That seems more scary, more volatile. And your house doesn't trade on an exchange, so you're not seeing the fluctuation in price. And so there's a lot of behavioral benefits to owning. I would agree with you. Renting is definitely not throwing away money. There's so many recurring costs of home ownership that increase with inflation, property taxes, maintenance, insurance. I think the main thing with the renting versus buying is the holding period. The longer you're going to be in a certain place and you're comfortable with that, then buying becomes more advantageous. But if you're going to be changing, moving a lot, then renting definitely becomes more advantageous because you're avoiding transaction costs and things like that. And so people definitely overestimate the returns on real estate as a primary residence anyways, which would segue into my next myth, which goes along with the real estate, which is rental losses on investment properties. So if you are using real estate as more of an investment, so like we just talked about primary residence, I wouldn't necessarily consider that an investment. But if you do have that rental income component, that's when it becomes more of an investment. But what I'll see from people sometimes is, they generate losses because they're, depreciating the property. Maybe they're just like, there's been a lot of upfront expenses into this rental property, and they're thinking they're going to be able to use these losses to like offset their earned income from their like W-2 employment. And it's just not the case. You can't use losses to offset earned income. You can only use those losses to offset rental income. And so you can use them in the future, but they may not be useful to you right now. So that's just a big myth that I see. How do you feel about that?
Yeah, absolutely. I would completely agree, and I think the overarching category might be like passive losses, right? You have like active or earned
Right.
income, right? And then you have like these passive things such as real estate, or maybe some other, maybe another private investment maybe you made, right? And you have these losses, and you're hoping they offset, but they don't, right? There's multiple categories, but one line would be passive losses cannot offset
Yep.
active income. Maybe eventually, right, they could. It's not that you cannot ever do it, right? A lot of times, if one of those activities is disposed of, a lot of times they're unlocked, right? But like you said, you're not offsetting your income. You might offset it, 8 years down the road when you maybe
Right.
dispose of that property, right, and it maybe unlocks it. But I completely agree that's a financial myth I see, and that's a decent segue into another one. You've mentioned previously, and I kind of tee you up, is about LLCs, right? And
Hmm.
different, so sometimes the magical tax benefits of those that are not so
With
magical.
a rental property, right? If you got your
Yeah,
LLC
yeah,
on.
yeah,
Yeah.
exactly. So what are your thoughts on that?
Yeah, so LLC, that's one I see a lot, is basically people think that, having an LLC, provides some kind of taxation benefit where they're able to like deduct things that they wouldn't normally be able to deduct or something along those lines. And basically what just an LLC is just for liability protection, right? It's a separate entity from your personal assets. So basically what you're doing is you're trying to separate the cash flows of whatever business you're doing or rental property so that if something were to happen in a liability event, only those assets owned by the LLC are able to be kind of pursued, whereas your personal assets are protected from liability events. Other than that, LLC passes through, all profits to or losses to the person who owns the LLC. But there again, you can only use if there are losses to offset future ones from that particular activity, not your earned income from other activities. So that's one that I definitely see a lot.
Absolutely. Yeah, I think you hit the nail on the head. There's no tax magic about an LLC, right? You can have the same business, the same lemonade stand
Yep.
with no LLC, and you're still able to deduct
Everything you would.
your expenses, the table, the lemons and whatnot. So no, I think that's a good one. Another one related to LLCs or business in general. I guess this could even go to individuals. Is sometimes what I see, the expenses or deductions are maybe overblown,
Mhm.
where say you're out to lunch with a friend, right, and it's like, oh, I'm going to buy lunch because I'll put it on my business card, right, for example, it's a business expense.
Yep.
Sometimes we treat these expenses or deductible expenses as if they're just like freebies, but we're still losing, right? It's like
Yeah, yeah.
me buying you a $20 avocado toast might save me $2 in taxes,
Right.
but it still cost me $18, right? So I'm still
Right.
negative. Or you hear that often with I'm only giving to I don't know, charity, for example, because of the tax benefits, right? Well, it's like you're still losing. You give $100, you might get 20, 30, 40, 50 back.
Yeah.
You're still out. Um,
What's better than a write-off? Keeping your money. That's what
yeah.
I say. But it's true. People will be like, you don't want to go out of your way to generate business expenses that you don't need to be paying, right? Like it's great to be able to write off expenses that you need to have. Like that's just makes sense from a business standpoint. But yeah, you don't want to be looking for expenses that you don't need to be spending. Because like you said, you're still losing 75% of that money, or not losing, but you're kind of being frivolous with that money, right? So I would definitely agree there. And kind of the similar talking about the overestimating like deductions, right? So another myth that I see is kind of people, hear about charitable giving, and I guess in the same line of itemized deductions, like how valuable their mortgage interest is on their property, which also goes to what we talked about earlier with the real estate, and how real estate's a superior investment because you can deduct the interest. But these things like itemized deductions, like charitable giving and mortgage interest, only really benefit you if you're doing a substantial amount that is above the standard deduction, which was increased to 12,000 per person. So it's hard to kind of really get above and beyond that unless you have a really big mortgage and you're doing a ton of charitable giving to really have an impactful amount of itemized deduction. So it's not really as useful as people think it is, and it's really only benefits a certain percentage of the population. What do you think about that?
Yeah, absolutely. And that was, you again, right on target there as far as, previously before tax reform 2017, it was, overblown a bit.
Right.
And then now post 2017, it's definitely
Really
overblown.
overall.
Exactly. Like you mentioned, 12,000 and change. is the standard deduction. Married, it's up to, double that, right? So we're at
Yep.
around 25. And yeah, you have to, if you're, for example, if you're in a no income tax state, you have to have $25,000 of interest, of charity, of medical, and if you're in a state with a high tax, you still need, maybe at least 15K of all of that. So there can be tax savings, and there's other reasons and benefits to donating money and giving to charity. Obviously, fully supportive, but sometimes all of the advertisements lead to folks that are disappointed. Like, what? I didn't get a benefit?
Yeah, exactly. You have to want to have the giving first before it even it's just an added little cherry on top to get that deduction. You want to do the giving because that's what you want to do, right? Not because you're looking for a deduction.
Yeah, totally agree.
Cool. I think the last one that comes to mind is just IPOs and people's expectations of kind of, how new companies perform. I think sometimes people tend to overestimate those returns. What are your thoughts on kind of IPOs?
Absolutely. No, IPOs are certainly an exciting time for a lot of folks, for bankers, and for individual shareholders of those companies. But I think the benefits and the excitement are certainly overblown, right? There's a lot of companies that IPO, and there's a little bit of a survivor's bias there. We hear about the big ones, we hear about the ones that explode. We hear about the ones that you could have gotten in on. But we don't hear about all the ones that don't do so well. And I wanted to have a stat or a chart to share for this conversation, but I know, but I don't. But I know a large number of them end up not doing so hot. Even some that do have that initial pop, right? They quickly, I guess, drop, right? If we want to rhyme. So I think. It's exciting, but can be overblown.
No, I agree. I think I don't have the stat either. I know what stat you're talking about. I think it's over 50% of IPOs are actually down after their first year of trading. And so I think the people that really benefit from IPOs are the employees who have equity in the company. And like you said, VC people and stuff that have early investors, because the biggest pop is going to come from private to public. Once it's publicly traded, the market is pretty good at determining what the fair market value is, and it may take some time to shake out. But usually these IPOs have very high growth expectations, and so if they don't meet these growth expectations, then you're going to see a downturn in the price. And so it can be exciting to invest in the new stock. For example, actually, I was in Market Watch a while back for Uber, and I was saying at the time, basically. Be skeptical about buying into Uber, because the people that really make the money are the people that, again, like I said, the employees and the VC people. And historically, IPOs do poorly in the first 12 months. And actually, if you look at Uber, it was negative from inception. And there's an opportunity cost, because if you had been investing in the S&P 500, you would have been up over that time frame versus being down. So you have to, be careful chasing that kind of sexy IPO.
Yep. And on top of that, right, even some of those pops that we see are overblown for the individual investor, because there's a listing price, an opening listing price, and then there's a price at which the average person can buy, logging into their account on E-Trade or Robinhood, right? So just because, I've seen recently is Allbirds, right, the shoe company. I think their list price was 15, right? But they didn't, so that's the morning of the IPO, but it's not till a few hours later that the company's actually tradable for someone to go buy. And at that point, and I don't have the number in front of me, but let's say it hit the market at maybe $23 a share, right? And so that's a quick math, over a 50% jump. It's sort of reported and talked about, but average person cannot purchase it at that $15, right? The average person is buying in at 23, for example. Right. So we're hearing this massive pop, which is true, but
they're not experiencing it.
Exactly. So they get at 23 and it comes back down to 15. Now they're down, I can't do the math, right? 30-something%. Even though the IPO would be flat in that case, right?
Right.
So You did say last one, and I'd love to wrap it up, but I think there's one more important one
Sure.
we should mention around credit. What are your thoughts around myths around
Oh,
credit?
that's a good one. Yeah. So I just think, and this is might be a hot take, but people just how much I hear people talk about credit scores, I think is overblown. Like I don't, yes, it's important to have a good credit score in the sense that, for potential employment opportunities, for borrowing money obviously is super important. But those things, especially for like the borrowing money aspect, only happen, you know, uh, limited times throughout your life. And you don't really want to be borrowing money. So it's like, yes, it's good to have a credit score, but like we overemphasize the importance of a credit score. Like we want to build good fundamentals with our money so that we're not having to borrow money as much. And so all these like different tactics around how can you boost your credit score, like your credit score is going to go up naturally if you're being responsible with your credit. And there's really not much more, in my opinion, that you need to be concerned about outside of being responsible with your credit. How do you feel about that?
Yeah, no, I totally agree. I think it's important, or it's nice to have, but it is overblown. Like for example, and I might need a fact checker on this one, but when you're applying for a mortgage, there's multiple categories, right? And one of those categories you want to be in is like the excellent category. And I believe that excellent category, at least for most lenders, again, happy to get fact check on this, is 740 and above.
Okay.
Right. And so, jockeying your credit score from, trying to get up to 800, maybe from 780, right? Having these little, marginal improvements might feel good and it might be good for bragging. But as far as the actual impact, you're already in the good category, right? You're already in the A plus category. You can't get a super A plus.
Exactly.
Um, so I totally agree. It's a little,
Gimmicky.
overblown, good, good to have, not bad to have. But
It's not
maybe,
going to change your life. Like it's at the end of the day, like building good habits around saving a certain percentage of your income and investing like that's going to move the needle more than focusing on your credit score.
exactly. And we certainly seen a loss aversion to credit score numbers, right? Again, it was at 800, and then I closed my account. Now it's at
Right.
795, right? It's like,
They'll come back
it's going to come back maybe in like a month or two, and it doesn't matter, right? It doesn't matter at all.
unless
So
you're applying for a mortgage right this second, like, yeah.
right. Yeah, again, which you're still in that excellent category.
Right.
And related to that, have you heard folks talk about keeping a small balance on their credit
Mm-hmm.
card? Have you heard that one?
Yeah, for sure. Yep, just a big myth in general. Like there's no benefit to keeping a balance on a credit card. Credit utilization, like how much you're using of your credit line, does have an impact to your credit score from things I've seen and read, as far as like staying below 30% of your available credit line. So if you have a $10,000 credit line, don't want to be carrying a balance of more than 3,000 at any time. But like carrying a balance in general doesn't impact your credit score. It doesn't improve your credit score.
Yep. I would agree. You mentioned there's not many tricks to increasing the credit score. And I agree that the one that we'll look at is what you just mentioned, that credit utilization ratio. Like if I see someone that maybe I think should have a higher score than maybe they do, that's the first thing I'll look at. And it's like, oh, you know what? This company has your income from when you were an intern and it's listed at $12,000 a year versus your
Right.
current salary at, XYZ. So just a flip of the switch, updating that salary, getting the increased credit, lowering the credit utilization ratio, that would
Exactly.
usually do the trick. But I think this was a good episode. Lots of information, lots of myths.
Lots of myths.
So we don't mean to beat up anybody. We've seen all of these as well, and maybe the financial media is probably the most guilty.
A lot of times it's to sell things, right? Sell products and stuff. I know me and you, we like to focus on like the practicality of things, right? Like where can we actually figure out ways to use our money better and more practical? And a lot of this stuff is like shiny objects, right? Like it doesn't really move the needle. So like, what can we focus on that will? And so it's good to know the myths.
Absolutely. No, we want the clients to live and people to live good lives and focus on the things that are important. And some of these things are noise and not important,
Yep.
right? And it's interesting, all this stuff we see about some of these things we've listed, and there's not much out there about maybe increasing your skills or negotiating for a higher salary or something that maybe could materially impact somebody. Instead, we're arguing over getting your credit score up from a 752 to a 756.
Exactly. Exactly. Oh, this is great. We're going to wrap it up for today. Any final thoughts?
No, good seeing you as always, and I love hearing your insights.
Likewise. Looking forward
Alrighty.
to the next one.